Hi, I'm Sherry Tolbert CPA, and we're going to talk today about the 20% qualified business income deduction that was a gift in the new tax laws. The first thing we want to know about it is, why do we care? And deduction always is good. We're always for a deduction, but what does that even mean? What it would be is a subtraction from the income, so that 20% would never be taxed, which is awesome. 20% is awesome to not be taxed. So that's where we're starting. Then the idea is that it's 20% of the qualified business income. So what is that? Because obviously they've put some limits and some distinctions in the law. We don't have all of the details of it now, but as it looks right now, just basic. All right, so what is qualified business income? Qualified business income comes from any pass-through business. The pass-through businesses are S-corps, partnerships, and sole proprietorships. So all of those are from pass-through businesses where the income from the business ends up on the owner's personal tax return and is taxed at the owner's personal rate. So that's qualified business income in general, but of course there's little rules that go with that. The S-corp has to have subtracted the reasonable salary of the owner. The partnership, the business income, has to have subtracted the guaranteed payments to the partners. The sole proprietorship does not have to subtract any owner payment at this point. So it just keeps the 20% from being so big, from being falsely big. So they're saying, give us the real income. Okay, that's qualified business income. Now they've put some limits on it so that the deductions don't go outside the bounds that they intended. There are two types of businesses that they're looking at. There's generally a service business, which would be a doctor, an accountant, any kind of business where the individual actually provides a personal service. Those businesses are going to be limited by income. If they have income over a certain amount, that's the taxable income, over a certain amount, they can completely lose the 20% deduction. So really this is trying to benefit smaller of those kind of businesses. So the non-service specific businesses will have once the taxable income gets to a certain amount, their 20% deduction will just be limited. So they won't lose it all the way. The taxable income is going to include spouses. All right, those taxable income limits are based on whether you're filing married or single. And so there'll need to be some calculations to see whether you've gotten up to that taxable income to enforce those limits. So just be sure that you get to work through exactly your situation to make sure you get the best benefit out of this law. And do it early so that by year end you're in the place that you want to be, because there is some planning opportunity.